Welcome to The Explainer. We're jumping right into a massive, frankly fascinating mystery sitting dead center in the global financial system right now. Imagine two completely different prices for the exact same asset, existing at the exact same time. It's a disconnect we really haven't seen in modern history, and it's flashing some huge warning signs about the state of global commodities. Let's get right into it. Okay, let's dive into this. The whole premise of our explainer today revolves around a pretty alarming question from our source material. What if the silver price you're checking on your phone right now is, well, a fiction? The source is issuing this urgent warning that a massive supply crisis isn't just some future prediction. Nope, they're saying it has already arrived in the real world. To see why they're making such a bold claim, we gotta look at the scoreboard. So picture this. On one side, you've got the Comex exchange in New York. This is the paper price you'll see flashing on Western financial news screens, sitting at roughly $75.84 an ounce. But look at the other side, the physical reality over in Shanghai. In their physical trading markets, buyers are shelling out $82 an ounce at that exact same moment. It is a wildly stark contradiction between what the digital screen says and what the physical vault actually demands. When you actually run the math on that gap, you're looking at a massive 9% premium. Buyers in Shanghai are willingly paying about $6 to $7 more per ounce for the exact same piece of metal. Now, if you follow global finance even a little bit, your alarm bells should absolutely be ringing right now, because markets are specifically designed to prevent this exact kind of gap from staying open for very long. Section 1. The missing arbitrage, a broken system. Right, so we all know how arbitrage is supposed to work, right? You buy the cheaper asset in one market and, boom, simultaneously sell it in the more expensive one. It's the foundational plumbing of finance that automatically forces global prices to equalize across borders. So we have to ask the obvious question. If you can literally buy silver in New York for $75 and sell it in Shanghai for $82, why on earth aren't traders just scooping up all that cheap New York silver, putting it on a boat, and locking in a guaranteed, risk-free profit? Well, the source gives a shockingly stark answer here. There is simply no physical metal available to move. The entire global arbitrage system, that mechanism that keeps worldwide prices in check, is basically broken because the physical vaults are running dry. Traders can't move the metal because they physically cannot get their hands on enough of it at that New York paper price. Section 2. The culprit. China's Great Silver Vacuum. See, China isn't just trading silver on a screen, they are consuming it for real-world applications at a staggering rate. They're actively vacuuming physical metal off the market at a pace we haven't seen in 2 decades. And it's driven by 3 massive tech trends. First, AI infrastructure. Companies like Meta and Microsoft are spending a combined $700 billion, and all those massive server farms need silver for electrical contacts. Second, electric vehicles, which use up to 79% more silver than your traditional gas car. And third, just relentless mass production of solar power. Because of this intense demand, and seeing how fragile the supply chain really is, the source notes China has taken some pretty heavy defensive action. They've actually reclassified silver as a strategic material. By doing that, they're walling off their domestic supply chain and have effectively shut down silver exports to the West. That severely restricts what's actually out there on the global market. Let's move to Section 3 and see how this builds. The systemic flaw, the Comex math of doom. Okay, the crucial metric to keep your eye on here is 76.88 million. That's the current registered inventory of silver on the Comex exchange, in ounces. So in plain English, this is the actual physical metal sitting in a vault right now that is readily available to be handed over to buyers. Now, 76.88 million might sound like a whole lot of metal, but that perception completely shatters when you hold it up against the paper market. You've got this illusion of unlimited supply flashing on the trading screens, totally clashing with the cold, hard reality of what's actually sitting in the physical vaults. Which brings us to what the source considers the most alarming metric of all, 7.5. For every single physical ounce of silver actually sitting in that Comex vault, there are 7.5 paper ounces being traded back and forth on the exchange. The source uses this incredible metaphor to explain the danger, and it's so good I'm just going to read it directly. Imagine going to your bank and finding out there are 7 people with a claim on every single dollar in the drawer. I mean, it perfectly hits the nail on the head regarding the systemic fragility here. As long as everyone is happy just trading paper, sure, it's fine. But the exact second people actually demand their physical asset, the math completely falls apart. And we're seeing signs of that stress right this second. The global buffer drain really started kicking into high gear back in 2021. The source's projections point to a really critical threshold coming up by January of 2026, where they estimate 26% of the entire Comex vault could just vanish in a single week. If a massive physical withdrawal hits like that, you're looking at a full-blown crisis mode run on the bank. Section 4. The inelastic supply wall. To really grasp the mining reality here, we have to remember that silver supply is highly inelastic. Meaning, even if silver prices absolutely shoot to the moon, miners can't just flip a magic switch, ramp up production, and instantly meet that sudden demand. The main reason for that inelasticity? A whopping 72% of all silver is strictly a byproduct. Miners are actually out there digging for other industrial metals like copper or zinc, and they just happen to get silver as a bonus. You don't just open a brand new silver mine because silver prices go up. You'd have to go through the years-long, agonizing process of discovering, permitting, and building a massive new copper mine, which is entirely dictated by the copper market, not silver. So the real kicker is this number. 762 million. That is the massive number of ounces that have been completely drained from global buffer stocks since 2021. The source points out that we've literally been in a structural deficit for 6 straight years. We are consuming vastly more than we are pulling out of the ground, and the tank is running perilously dry. Section 5. The source's verdict. Navigating the silver crisis. According to the source, the biggest takeaway for anyone looking to buy is that the screen price is becoming increasingly irrelevant. While that fictional spot price might proudly flash $75.84, your reality, if you walk into a precious metals dealer today, will likely be somewhere between $80 to $85 an ounce. Why? Because even the dealers can't source the actual metal at the paper price. Based on all this data, the source has some pretty urgent advice. Waiting around for a market dip down to $60 is a seriously risky move. They make it clear that the $71 low we saw back in January was a gift that's probably gone for good. Their stance is that the time to buy physical silver is right now, while the metal is actually still available, before these vaults hit their breaking point. So, as we close out this explainer, I want to leave you with one final, kind of provocative question to chew on based on everything we've uncovered. If the global arbitrage system is genuinely broken right now, and these paper markets are mathematically stretched to their absolute limits, who really controls the true price of silver? Is it that digital screen in New York, or is it the physical vault in Shanghai? It's a fascinating, honestly kind of wild look at the fragility of our financial systems, and definitely something to keep a close eye on.